Assalamualaikum to Tuan Hasham. My name is Nurin Shahira binti Syamsul Azlan and my matrix number is 01DAT23F1060. I will do a video presentation of case study of Malaysian Taxation 2 DPA50163 Session 1 2025 and 2026. So, this is our group members and we are from group 1. For our video presentation, we will be covering 5 main parts. First, the introduction. Second, question A, tax computation for the year of assessment 2024. Third, question B, tax planning strategies. Fourth, the conclusion. And lastly, the references. Tax planning is an important part of managing a successful business. For Zentage Solution Berhad, having a good tax strategy helps the company grow, stay competitive, and follow Malaysia's Income Tax Act 1967. By planning wisely, Zentage can take advantage of various opportunities such as staff training claims, R&D incentives, approved donations, and foreign income exemptions. These efforts not only help reduce tax expenses but also improve the company's reputation and supports Malaysia's economic goals.
Assalamualaikum and hi, my name is Noradila binti Nur Samsi. My matrix number is 01DAT23F1049. I will start the presentation by explaining tax computation for Zentage Solution Berhad for the year assessment 2024. I will start with net profit before tax, which is 510,000. Then we add back non-allowable expenses that consist of first, gift to client 25,000. The gift to client in the form of branded merchandise is classified as entertainment expenses under Section 39(1) of the Income Tax Act 1967. Entertainment expenses are not deductible unless they meet certain allowable categories. Since this gift does not fall under any allowable category, for example, as promotional samples, trade fairs, so it is disallowed. Next is managing directors insurance 40,000. The insurance premium paid for the managing director's personal coverage is considered a private expenses and it's not incurred wholly for business purposes. Therefore, it is non-deductible under Section 33. Then, donation to Mara Education Fund 30,000. Donations are deductible only if made to approved institution. Next is depreciation 200,000. Depreciation is an accounting expenses, so it is not allowable for tax purposes. Last one is office renovation 45,000. The expenditure on partition replacement is considered as capital in nature as it brings long-term benefit. Such expenses are not deductible unless qualifying under a specific capital allowance incentive, which does not apply here. So, this giving total of 340,000 for non-allowable expenses that we should add back with the net profit. Next, we deduct double deduction, which are special tax incentive that include training expenses of 60,000. The training expenses incurred for staff are claimable under the Human Resource Development Corporation, HRDC. Second, OKU staff salary of 36,000. The salary for employing an OKU disabled employee is eligible for a double deduction under the Income Tax Rule 1982, deduction for the employment of disabled persons. And lastly is approved R&D expenditure of 180,000. The expenditure incurred for approved research and development (R&D) is eligible for a double deduction under Section 34A4 of the Income Tax Act 1967. So, total double deduction amounting to 276,000. Next, we list non-business income. First is dividend income. The 60,000 dividend received is exempt from tax under the single-tier system introduced in 2008. The company paying the dividend has already paid the corporate tax, so shareholders are not taxed again. So it is excluded from taxable income. Second is government grant for R&D, 100,000. Government grants received specifically for R&D purpose are exempt under the Income Tax Exemption Number 22, Order 2005. So it is excluded from taxable income. So after all the adjustment, we get an adjusted income of 574,000.
After determining the adjusted income, which is 574,000 ringgit, from this we subtract the unabsorbed capital allowance from the previous year, which is 50,000 ringgit. Next, we deduct the capital allowances for the current year. For computers, 20% of 150,000 ringgit equals 30,000 ringgit. For office equipment, 10% of 100,000 ringgit equals 10,000 ringgit. For motor vehicles, 20% of 120,000 ringgit equals 24,000 ringgit. And the total capital allowances for the current year are 64,000 ringgit. After deducting both the previous year's unabsorbed capital allowance and the current year's capital allowance, the statutory income is 460,000 ringgit. We then consider other sources of statutory income such as dividends or government grants for R&D, which are exempt from tax. Therefore, the aggregate income remains 460,000 ringgit. Next, we deduct donations to approved institutions under Section 44, Subsection 6. In this case, a donation to the Mara Education Fund of 30,000 ringgit is allowed, resulting in a chargeable income of 430,000 ringgit. And finally, the tax payable is calculated at 24% of the chargeable income. This means 430,000 ringgit multiplied by 24%, which equals 103,200 ringgit. Next, I will continue with question 1B by explaining 5 tax planning strategies to help Zentage reduce its tax liability. The first strategy is to increase charitable donations to approved institutions. Under Section 44(6) of the Income Tax Act 1967, donations made to approved organizations such as the Mara Education Fund are deductible up to 10% of the company's aggregate income. If Zentage increase its donation from 30,000 ringgit to 80,000 ringgit, the additional deduction of 50,000 ringgit will result in tax savings of 12,000 ringgit. This strategy not only helps reduce the company's tax burden but also enhance its corporate image through greater social responsibility. The second strategy is to increase HRDC claimable staff training. According to the income tax deduction for approved training rules 2014, companies are entitled to a double deduction for expenses related to approved staff training programs. If Zentage spends 100,000 ringgit on staff training, the company will receive additional tax savings of 24,000 ringgit. This strategy not only helps reduce taxable income but also improves employee skills and productivity, benefit the company in the long run. The third strategy is to claim research and development incentives. Under Section 34A of the Income Tax Act 1967 and PU bracket A 293/2022, expenses for approved R&D activities qualify for a double deduction. If Zentage invests 180,000 ringgit in research and development projects, the company will enjoy tax savings of 43,200 ringgit. This strategy not only helps to reduce the company's tax liabilities but also encourage innovation, strengthen competitiveness, and supports long-term business growth.
The fourth strategy is claim foreign income exemption. Under the Income Tax Exemption number 11 order 2005, income earned from foreign clients such as from Singapore or Indonesia, and it can be exempted from tax. If 200,000 of foreign income is exempted, Zentage can save 48,000 ringgit in tax. This can help to promote international business expansion without extra tax burden. The fifth strategy is upgrade equipment to claim higher capital allowance. By replacing old asset with new ICT or computer equipment, Zentage can claim 40% initial allowance and 20% annual allowance under Schedule 3 of the ITA. For example, upgrade equipment worth 150,000 give an additional 7,200 tax saving. This can reduce future taxable income and improve operational efficiency. In conclusion, tax planning is not just about reducing tax. It's a smart financial strategy that helps a company to grow and stay competitive in the long run. For Zentage Solution Berhad, our analysis shows that the company has several opportunities to save on taxes. These include increasing charitable donation to approved organizations, providing more HRDC claimable staff training, claiming R&D incentive, applying for foreign income exemptions, and also upgrading equipment to enjoy higher capital allowance. Additionally, by expanding its business internationally, Zentage can benefit from export tax exemptions. By implementing these strategies, Zentage can lower its tax burden and strengthen its corporate image to ensure full compliance with the Income Tax Act 1967 and contribute to Malaysia's economic and social development. Lastly, it's important for the company to continuously review its tax strategies and seek for professional advice to stay updated with new incentive and any legislative changes. Here are the references that we use in preparation this presentation. Our information and calculation are based on official sources from the Inland Revenue Board of Malaysia, LHDN, include Public Ruling Number 1/2023, which explain the tax treatment of donation, Public Ruling Number 5/2022 about R&D expenditure, and of course the main legislation, the Income Tax Act 1967 and the Income Tax Exemption Number 11 Order 2005. All of these references ensure our tax planning strategies are accurate and comply with Malaysian tax law.